I am warning you right now, the real estate market in 2026 is not preparing for a normal slowdown. It is preparing to destroy millions of investors, not slowly, not gently, but financially violently. And if you are not prepared, this market will not care about your emotions. Listen carefully. I have been investing for more than 3 decades. I lived through the 1990 real estate crash. I survived the 2008 financial collapse. I witnessed the 2020 liquidity freeze when entire sectors stopped overnight. And I learned something very important. Crashes do not come out of nowhere. They leave signals. Data speaks first. The crowd understands later. And right now, the data is screaming. In 2021, the average 3-0-year mortgage rate was around 3%. Today, it is hovering between 6.5 and 7.5%. Most people think that is just a small increase. It is not. It is a structural break in the economics of real estate. Take a $500,000 property. At 3% interest, the monthly payment was around $2,000. At 7%, that payment jumps to more than $3,300. That is a 57% increase in cost. Did incomes rise 57%? No. So where will the buyers come from? When affordability collapses, demand collapses. When demand collapses, prices eventually follow. This is not emotion. This is mathematics. Now let's talk about the next danger. Between 2025 and 2027, trillions of dollars in real estate loans will reset. These loans were taken during the era of cheap money. They were structured around 3% interest rates. Now they must be refinanced at 7% or higher. Many investors will not survive that transition. Their payments will double. Their cash flow will turn negative. Banks will refuse to refinance weak properties. And then comes forced selling. Markets do not crash because people want to sell. Markets crash because people are forced to sell. That is when prices fall fast. Now consider commercial real estate. Office buildings were once considered safe investments. Today, in many major cities, vacancy rates are above 25 to 30%. When occupancy drops, income drops. When income drops, property value drops. A building once valued at $300 million can suddenly be worth $150 million. That is 50% destruction of value. Banks have issued massive loans against these properties. If those loans fail, banks tighten credit. When credit tightens, buyers disappear. When buyers disappear, transactions freeze. And when transactions freeze, panic spreads. Now let's talk about leverage. Debt is a tool, but without discipline, it becomes a weapon. An investor who bought property in 2021 with an adjustable 3.5% rate may face a reset to 7.5% in 2026. Thousands of dollars in additional monthly payments. Rents will not cover the increase. Negative cash flow begins, and negative cash flow is what destroys investors. It does not happen dramatically at first. It happens quietly, month after month, until reserves are gone. Another dangerous illusion is paper wealth. People open an app and see their home value increase from $400,000 to $650,000. They believe they made $250,000. No. Until you sell, it is only a number on a screen. In 2008, millions borrowed against inflated equity. They spent it, then prices dropped 30 to 50%. They were underwater. Their debt was higher than the value of their property. That is financial prison. Now we must discuss liquidity. People believe they can sell anytime. That is not true. When fear enters the market, buyers vanish. Listings sit for 6 months, 9 months, 12 months, then sellers panic. They cut prices aggressively, and the decline accelerates. The exit door in real estate is small. When everyone runs toward it at the same time, most do not get out safely. So what am I doing with my own money? First, I prioritize cash flow over speculation. I do not buy appreciation stories. I buy income streams, strong dividend-paying companies, businesses with low debt and consistent cash generation. Second, I am holding more cash than usual. In uncertain environments, cash is not trash. Cash is optionality. During crashes, those with liquidity build empires. Third, I am participating in private credit opportunities. In a high interest rate environment, lenders gain power. If you cannot be the borrower, become the lender. Fourth, I am extremely selective with real estate. I am not running away from real estate. I am avoiding bad real estate. Only properties with strong positive cash flow. Only assets that survive high interest rates. No assumptions about rapid appreciation. Now let me summarize the 5 major threats I see in 2026. Number 1, the interest rate time bomb. Number 2, the commercial real estate collapse. Number 3, excessive leverage. Number 4, the illusion of fake equity. Number 5, the liquidity trap. Crashes do not destroy disciplined investors. They destroy unprepared investors. Every major downturn in history created enormous opportunity for those who were patient, liquid, and rational. Wealth is not built in comfort. It is built in uncertainty. If you prepare while others are optimistic, you will survive when others panic. And if you remain calm when others are emotional, you will acquire assets at prices that once seemed impossible. The market does not reward hope. It rewards discipline. Prepare now, because 2026 will not forgive ignorance, and those who act early will not only survive, they will dominate the next cycle.